Well, we had some traction with our AT&T video on YouTube, and I'm a fan.
Blew my mind.
Right. I don't know why everyone's in love with it, but we thank you for that, and we welcome all of the new subscribers. We had some traction with AT&T. I love AT&T. We went over the story that my mother worked there since the 60s, but I've been told for the past decade that Verizon is just straight up better than AT&T. The coverage, the everything. I am quite frustrated with AT&T, but we're not here for all this bullshit. We are here to analyze.
What service do you use?
I use AT&T. What about you?
I'm Verizon.
Verizon. Do you love it?
Yeah, I do. I mean, define love. It's not like I'm like, oh my God, it's the best
You
thing
want to
ever.
make love to your phone?
I switched about 16 years ago to Sprint.
Come on.
3 months later, I was like, this thing sucks. I'm out.
Yeah, so Paul's now on Cricket Wireless.
By the way, what's funny about Cricket Wireless, my good friend Matt, the chess coach, he's on Cricket Wireless.
Oh, sorry, Matt. Too soon.
I had to show you a video, by the way, that he wanted me to show you.
Okay.
It was funny.
So let's talk about Verizon now. Verizon stock. We're going to go over the 8 pillars and see if this stock is potentially a buy for Paul.
Yeah.
Pillar number 1. Let's look at the revenue growth over the past 5 years, Paul.
All right, so we go to our financials. We go to our income statement. Annual. Okay, Uncle Seth. 5 years ago, 131, 126, 126,
Okay.
130, 131.9.
Not growing.
Not growing.
I'm shocked. Their
Yeah, I am
marketing
too.
department is okay. That's interesting.
Well,
What
let's see the last 10 years, though, just to skip back. And by the way, there might be some acquisitions along the way. I don't know.
Okay.
We had 106, 110, 115, 120, 127. And here's what I want people to see.
Go on.
This is proof. Imagine you were sitting in 2015 and you did your pillars.
Yes.
You looked at the last 5 years going, oh, this is pretty good growth.
Yep.
And then it was stagnant for 5 more years. Mm-hmm. So this is a very good example to look at. I think we've seen this in a few companies we've looked at, that just because the past looked good, the bigger and bigger you get, the harder and harder it is to grow.
That's right,
I
you
still
say
like
that.
looking at the past to sit there and see how they operate, but that's just an example of, I would, even though this is there growth? Very minor growth. We're going to call this an X. And it's a checkmark X combination.
Number 2 is profit growth. What is it, Paul?
17.9, 13, 30, 15.5, 19.
It's all over the place.
It is all over the place. Again, go back to the last 5 years, 2.5, 2.4, 875 million, 11.5 billion, 9.6. So one of the things I would be doing here is I'd be looking at it saying, why are these massive fluctuations happening? What was going on above here? The point is, they are still profitable, right?
Yeah.
They're still creating profit,
Sure.
things like that. So I'm not exactly turned off, because remember, a company that's still up and down but always making money, it's still a way to get a good return on your money. There might be reasonable reasons why their profit fluctuates year to year. I don't know what those reasons are, but that could be there. Can we skip to one ahead?
Go ahead.
You know, we always talk about the decreasing shares.
Yes.
It's already on this profit and loss statement,
idea.
so let's
Go
just look
ahead.
at it right now.
Okay.
Shares outstanding. Oh, boysies. 2.8 in 10 years ago, 4.1.
That's a lot, Paul.
That's a big one. That's 50% increase. So what does that mean?
They've been selling shares to the public to drum up more money.
For whatever reason, either through acquisitions, for doing a bunch of things. But this means if you owned, what's the exact math? Essentially, if you owned 10 shares 10 years ago, it's now like you own 7 shares. I don't know if that's the right math. I think it's the right math.
Okay.
That kind of stinks.
Yes.
So, listen, they're diluting you. That's not exactly a thing. In my opinion, that's not a good thing that a company will do for their investors.
How about pillar number 4, free cash flow, which is cash from operations minus capital expenditures. Paul.
Oh, my Lord. Praise the Lord Jesus Christ, my Savior above. This is the first time. Did you study it ahead of time?
Folks, we've been podcasting for 2 years now, and I finally got free cash flow. It's right in front of me most of the time.
I swear to God, I was sitting here going, what's he going to say this time?
Now, that's not a guarantee I'll know it next week, Paul. But,
That is true.
Okay, free cash flow.
Okay, free cash flow. So cash from operations, you go to your cash flow statement. You go to your cash from operations. 39 minus 27 is 12. 21 minus 17 is 4. 24 minus 17 is 7. 34 minus 18 is 16. 35 minus 18 is 17. So it's had a little bit of fluctuation, but it is still going up. There's some aberrations in these years. Again, a good thing to understand why that is. But it is going up. Look at the previous, it was 16, 13, 11, 21, 13. They have very inconsistent cash flow. Free cash flow, right? But it's always positive. It's always there. Now, this isn't bad. This isn't awesome. I mean, I should say it is awesome. They're always making money. But these 4 and 7, I don't know why that happened. 17, 16, don't know. But they had a peak of 21. These are things that's like, just like everything in life. Not one thing just makes or breaks everything. This is covered overhead view. From what I'm seeing right now, on the first 4 we've done,
Yes.
the only one I don't like is the diluting of shares.
Shares, yeah.
The share count. So let's go to the next one.
How about PE ratio, which is stock price over earnings?
Yep. And we'll go to the current PE. The trailing 12 months current PE. Oh, look at this one.
We want it to be between 15 and 20. What is it, Paul?
13.
Wait a minute. I'm buying right now. Get my Fidelity app open here.
I mean, not bad. 13? That's pretty good.
What also would be really great is if you smash that thumbs up like button. Guys, we can't thank you enough. We've gotten a zillion subscribers the past couple weeks. We're very excited. Paul's been checking the list about every 13 seconds, and we really appreciate that thumbs up.
I literally hit refresh. Like,
I love the way it looks.
It's looking great.
We're getting a lot of positive comments, and it's because of you and our OG watchers of the.
You know, we had a few people congratulate us on hitting 1,000 subscribers.
That's very nice. Very nice of you people.
It's impressive. Do people do that a lot? They watch the channels they do to see where they're getting. I mean, how many subscribers they have?
Paul, you have fans. Either it's the tight pants, it's the charismatic charm.
Very high shorts today.
What? So tell me about that PE ratio. We haven't seen one this low in a while.
Yeah, it has been a while. I mean, Verizon's a boring company. The thing I like about it is, you know, it's not like let's see the last 12 months. It's not like there's some major aberration in profit where it's like, oh boy, you know what I mean? They're pretty consistently previous 12 months in this 19 range, 16, 15, 30. So it's not some fluke. Their biggest years, they had $30 billion in 12 months in profit. The last 12 months have been $19 billion. Right? And that's actually, since we're here, let's go to the quarterly look and see how they did during the recession.
You hit annual. You see how
that's a hard one. Annual. What's that from?
I don't know. I'm sorry.
Dumb and Dumber. He's
What?
reading the newspaper thingy. He goes, annual.
The tough one is the. He's like,
No, that's not the tough one. It's annual.
annual?
I'm pretty sure
It's
it
a
is.
tough one. All right, go ahead. Sorry.
All right, so quarterly. So
Comment below if you absolutely love. Paul and I will watch Dumb and Dumber like 7th grade boys in his theater together.
by the way, we have to watch A Few Good Men here. I was thinking about the other night. I'm like, we got to have A Few Good Men for a
Popcorn night.
movie night sometime.
Keep going. What the hell are we talking about?
Okay, so I wanted to look at how this company did during the recession.
Go on.
So in March, they had a quarter end, and in June. So if you remember, March was kind of like the holy shit, month.
March of this year, yes.
Yes.
COVID month.
So they made $4 billion in that quarter. They made 4.7 last quarter. And if you look at previous quarters, I mean, they didn't really fall off that much.
They did not.
If you think about it, why is that?
People got home when they wanted to talk to each other, or people were home, so they still use their phone?
Yeah, and they were still getting money from the government to pay a very measly $100 bill.
Yes.
They were probably paying that bill all day long because they didn't want to lose communication.
Right.
So this actually seems like a very hey, it's kind of like, I remember when I'd buy apartment buildings and we'd find, lower income apartment buildings. They might not have furniture, but they had sweet ass devices. They had awesome TV, iPads, things like that. You're like, what's going on over here?
What about total current assets over total current liabilities?
So by the way, I will say,
Go on.
this is probably, I was thinking about it the other night. I was like, what should I say about this one? This is probably my least important one.
Okay.
And here is why.
Go on.
I'm actually thinking we should replace it with something else.
Oh.
Or change how we look at it.
But Paul, it's a pillar.
I know it's a pillar.
Okay, go on.
To me, it's funny. This is the least important one, but I really like seeing it, if that makes sense. Like, if it doesn't have it, what's important is the industry or it's in a one that doesn't have this very often? Because like restaurant business, you're never going to have this.
Okay, right.
Right? It all depends on the industry you're in. Real estate business? No, you'll have it in the real estate business.
So
all right.
Total current assets over liabilities.
Okay, we go to the quarterly number. Total current assets, $37 billion. That's a lot. And what's the current assets, Seth?
You just said, what do you mean? Oh,
What are current assets?
Oh, money on hand, right?
Yep, basically money on hand.
Yeah, basically money on hand.
So $37 billion. Oh boy.
How many?
$39 billion. Not far off. But again, this is what we want to do. We want to look at previous quarters.
Okay.
So $41 billion, $41 billion, $37 billion, $44 billion, they pretty much always have a negative current assets to current liabilities. And that's why I look at it going, I'd want to look at Sprint. I'd want to look at AT&T. I think AT&T didn't have this either.
Yeah, I think you're right because it's like billing. Yeah.
So it's, again, I prefer a company to be able to have more cash on hand than bills. But at the same time, it's understanding their business and understanding why that may be the case.
What about price to free cash flow minus 15?
Okay.
Less than 15.
Less than 15. Okay.
Price to free cash flow.
And by the way, we should move that up a little bit earlier when we do the free cash flow statement.
Okay.
So the previous 12 months, we're going to go to the previous 12 months free cash flow. It's at $21 billion. Okay. So if you want to be 15 or less, we want their company to be worth $315 billion or less.
This is total market cap?
Yep. Because remember, the last 12 months, they had $21 billion in free cash flow.
Okay.
We're going to multiply that by 15 because we want the ratio to be less than 15.
Got it.
So that gives you a value of $315 billion.
I think their market cap's much more than that, Paul.
Much more? $247 billion.
Oh.
So, ding, ding, ding. In fact, they are at about 250 divided by 21 equals 11, 12. Call it 12.
12, yeah.
It's less than 12.
11.9.
Yeah. It's pretty good.
Yes.
So far from two important metrics we have, PE and price to free cash flow, we've got a good number here. Right?
What about profit margin greater than 10%? I would assume that's the case for this, right?
15.5%.
Look at that gross profit.
The gross profit, exactly. Wow.
You see, Don?
Wow. 61%. What does gross profit margin mean?
Well,
so you just went there and got all cocky. Look at that probably. Look at that gross margin.
I know it's high compared
Yes.
to like car companies or
So it means
Walmart's.
for every extra additional dollar in revenue, they're going to add 61 cents of that to their bottom line. It's the marginal profit per extra unit sold, dollar in revenue, however you want to look at that. So right now, they have a really good they have a good gross profit margin, and their profit margin per quarter is very high, 15.5%. Now, one of the things you might want to look at is, let's look at their historical gross profit margin. So we can click on that, and it's pretty, consistent. There's a few aberrations, which is likely, but recently it's been double digits all day.
This new word, aberrations, you're using it a lot this podcast. I haven't heard you say it a lot.
Oh, I'm sorry.
So that is our last pillar, Paul, because we kind of jumped around. But the point is, I have two questions, and maybe if you're a viewer, you might be wondering the same thing. I would think that most people don't even analyze their own budget numbers, including myself,
Yeah.
in terms of money in, money out, profit, yada, yada. So why would we expect them to do this? Is this overboard? And why this whole time did we have not even looked at the price of the stock? I kind of know why, but tell our viewers what.
Well, first off, the price of a stock is reflected in the market cap. So I look at the price of the whole company. How they divide it up in number of shares, I don't care. But I do want to understand how many shares they have they're increasing by. I will say the only thing I don't like about this company right now, based on what I've seen, is the number of shares outstanding keeps increasing. If that was steady or lower, I would be immediately going, okay. And by the way, it still could be okay. I don't know why they're increasing their shares. They could be increasing their shares from, that's part of the whole analysis you need to do. Is this overboard? It all depends on what you want to do.
Yes.
For the average investor, is it fun to learn this stuff? Hey, we've seen from the comments people make, they like hearing it.
Here's where I get a little confused, and I'm on the damn show. So we look at stocks that are incredibly overpriced that you're not buying.
Yep.
But then by the time they get in the wheelhouse of potentially buying, the company might be in the tank, like Carnival Airlines.
See, I don't think Carnival's in the tank. I don't think Southwest in the tank. I think they're having a short-term aberration. I think they're having a short-term issue related to the economy. Are the operations in the tank currently? Sure, but just like Seth, when you get sick with the flu, are you going to be sick forever?
No, but I mean, we sort of chastise people for buying that overpriced, sort of trendy stock that very well might be going up or down, of course. But then
What do I chastise? Because you're right. I want to make sure I'm very clear about what I'm chastising.
I want to make sure, too. I think you chastise when people don't consider the health of a company and they just consider the trends of the population.
I am okay with trends. But don't confuse it with then all of a sudden people come out and say, no, this company is growing so much and that's why it's a good investment. Time out. That is not why it's a good investment. Part of my trading that I'm going to get into has to do with trend following. That's a totally different strategy than what we're talking about here. When I hear people mix this with what's going on in the chart, that's where I get a little confused, going, hang on a second. That's not the same thing. When I hear people say it's growing like crazy, so basically I'm willing to pay whatever it takes.
Yes.
No, that doesn't work. But if you sit there and say, Paul, I don't care what the financials are. All I care about is this stock going up? I can respect that. I will absolutely respect that. But the second you start telling me, like, Paul, you are wrong because your analysis is wrong, then I have a problem. I go, well, wait a second. My analysis is not incorrect. What might happen might say I'm incorrect, but that's not an incorrect analysis.
Sure. Oh, so you're saying we better start with a very...
if your goal is to invest...
Go on.
And understand why a company...
Go on.
Understand why a company might be around and successful financially for 10 years. You need to understand the financials. If your goal is just to...
Day trade and have fun.
That's a totally different environment, and I fully respect that. And you know what you're going to say? I don't care what company it is. And you shouldn't. As part of my trading that I'm getting into... I couldn't give a rat's ass what this is.
Well, you're saying the way you do it, this sort of expert analysis. We don't care about the company, and we actually don't care about the price.
No. What I'm saying, when you're day trading, essentially, you don't care about the company. All you care about is where the movements are.
Oh.
When I'm investing like this, I care about the company in the sense of where do I think the next 5 or 10 years are going to be. That's what I care about with the company. But I care a lot about the financials to back up a big story. Like, okay, is this making sense? Is this making sense? And then you have to run your numbers and say, let me make some assumptions here. The thing I have about the Tesla thing, for example, is when the Tesla fanboys come to me and say, Paul, you're wrong because of... I'm like, well, no, I'm not wrong in how I'm reading the numbers.
Right.
How the outcome might be incorrect.
Sure.
But if you're investing in a company...
You'd rather hedge your bets on numbers than just speculation.
Yes. But if you're going to speculate all you want. Just acknowledge it's speculation.
Of our 8 pillars, we never actually talk about dividends. How big of a role will that play in if this is a little more profitable of a stock?
Great question. Dividends, I like getting dividends. A lot of people like getting dividends. Why is that?
Well, you get a free percentage of your investment.
Not free, but yes. Like, look, they're paying 4.2%. So if this company does nothing for 10 years, you're still going to make 4%. As long as they keep the dividend going, you're going to get 4% return on your money for 10 years.
Yes.
The thing about dividends is it takes money out of the company that they could be using for other things.
And they make a lot of money when they spend it, right, on the margin.
Yeah, they make a lot of money. So you look at it and go, are dividends a nice thing? It depends on how big the company... This is a big company. I want to see some dividends. Because to me, it's like, guys, how much bigger? Like, you're not going to be able to, give me some money for being an owner.
Yeah.
If it's a small company that's still growing, you want this to be zero. You want them to invest back in the company, right? So it just all depends on what your philosophy is and where the company is and all these things. Like, if you're older, Verizon might be a good option for you. Because if it's reasonably priced, which it kind of is, and it pays a good dividend, maybe you're okay with that. Like, okay, I'm going to get some income out of it.
Yeah, okay, I see. Interesting.
There's no cookie cutter, this is the right answer.
So looking back at the graph, going back to COVID time, I mean, would it have been wise to get into Verizon?
Well, you tell me. In hindsight, Seth.
Yes.
Would you have bought at... It's actually not much higher. What is it, 51 it went to?
Okay, interesting.
Look at that.
Hasn't fallen that much at all.
No, it hasn't. That graph looks a lot more dramatic than it actually was.
It's like, dun, dun, dun.
I was like, wait a second. So let's go to like a 10-year graph of Verizon.
Okay.
And that's pretty good. It's doubled in 10 years. That's about 6%, it's about a 6% return plus your dividend. You're getting about 10% return.
So overall, take home for viewers, what do you think about this stock?
Apart from the shares being, and I guarantee, if there's one data that nobody ever looks at, if they even go into the data, it's the number of shares outstanding. I look at it going like, I'm not offended by this. You just got to calculate if they keep increasing the number of shares as they have been, how much is that going to dilute me over the years? That is an important calculation to understand, right?
Yeah.
So that's the only thing I would sit there and say. And let's see if it's decreased. It has slowed down in the last 5 years. Oh, they did here's what happened. Look at this, Seth.
Okay.
2.8, 2.8, 2.8, 2.8, 3.9. So 4. 4, 4, 4, 4.1, 4.1.
Oh, so
they had a big jump. So something happened here. Maybe an acquisition. So we can go back here, and this is getting way too detailed.
Come on, Paul.
2014. What'd you say?
I said, come on.
What do you mean, come on?
I mean, you're going to go into what happened in 2014?
Yeah, I am.
Okay, go ahead.
So I'm going to go to the annual statement again over here on the statement of cash flow. So the statement of cash flow is going to show where all the cash in the company went.
Interesting.
Acquisitions. There's a line in investing because acquisitions are investing line. 2014. Actually, there wasn't. Wasn't any big acquisitions.
Go up one.
Oh, sorry. Thank you.
There you go. 42 mil to $3 billion.
Yeah, $3 billion. Okay, so they made $1 billion.
Something happened.
So they also sold something the next year. But I'm wondering if $1 billion. That's still. They increased the number of shares by $1 billion, and the stock was 40. So they raised $40 billion. Maybe it has to do with financing. Oh, there it is.
What, Paul?
Boom. Look at that. 2014, they spent $58 billion in financing.
Say it again. They spent what?
$58 billion.
Oh, what is that?
So there's a big thing. 2014, cash from other financing activities. So they spent $63 billion in cash from other financing activities. So guys, this is the part where you sit there and go, I need to understand what that was. Was it something to decrease? Oh, let's look at their debt.
Oh, Paul, I love it.
So then, why do you love it? I thought.
I'm just thinking, if you're a viewer,
and you're hearing me talk about this.
Well, no. I don't think there's not many people I know that would figure all this shit out.
Okay, so total long-term liabilities. Boom. Wait.
Boom. Wait.
Wow, these are big jumps. What's the deal here? 151 to 190.
What is that again?
Their long-term liabilities jumped $40 billion that year too. So they issued shares and took on a lot of debt. That's kind of like a double whammy to investors. So I'm not understanding something. And this is why we can't do it just in this episode. That's when you have to sit there and go into their financials, their 10K, and understand from 2014 something happened here. And I'm going to tell you right now, it's going to be listed there because there's no.
What happened, Paul?
So they got $60 billion, some billions in cash, and $60 billion in stock.
Wow.
There it is.
That's the major.
So do you see what we did there with the financials? I look at the financials, and then Don goes, okay, what was big? What would you Google?
What happened to Verizon in 2014?
There you go. Perfect. But the thing is, Don, you're laughing, and Seth, you're laughing. That's exactly what you do. So Look at it going, okay, now let's go to their revenue and see if that thing worked out well for them.
I mean, does all this now make sense, Paul?
It does make sense. Now, the question is it the right thing? Oh, man, their revenue did not go up by much at all. The revenue went from $127 billion to $131 billion. Their profit went from 9.6 to 18. Maybe it did actually. That's a big jump in profit.
Double?
I mean, yeah, pretty much. I mean, look at their profit before: 2.5, 2.4, 875, 11.5, 9.6, 18, 13, 30. So in the last 1, 2, 3, 4, 5 years since they did that transaction, they've made 34, 64, 77, 94 billion. The previous 5 years, they made 5, 6, 17, 20. So they triple, quadrupled their profits. So maybe it was the right decision.
Wow.
So actually, Verizon might be a good company to buy.
Wow.
I'm actually going to be looking into this further.
Great, Paul.
Yeah.
Thanks for watching the Everything Money channel. Destroy that freaking thumbs up button so we can celebrate on our end.
Let's look how many subscribers we have right now.
We appreciate your support. And Paul and I and Donald, Uncle Don, we text all weekend. I had conversations with Paul that I felt like our 1,000th subscriber was like our 1 millionth, Paul. It just felt that good.
You know, I told Don, I'm like, I even said to him yesterday, Don will verify, I'm not wasting our time unless we're trying to get to 1 million subscribers.
Yeah.
Because imagine all the great things we can do and how much better the studio will look with 1 million subscribers.
Thanks for watching Everything Money
We
channel.
might be able to start on time every once in a while.
With Seth and Paul. Follow along.
Right.
Subscribe. Thanks, guys. Appreciate it. Bye.